Within 60 minutes, trillions vanished. Gold dropped, silver collapsed harder, stocks bled, crypto followed. But here's what they're not telling you. This wasn't panic, this was machinery. While everyone searched for headlines, algorithms were rewriting the rules. A government mint rumor surfaced, physical silver disappeared from vaults, premiums exploded, and somewhere between New York and Shanghai, a price gap opened that shouldn't exist. One friend called twice. Desperate to buy at the worst possible moment, we stopped him. Because what happened next separated those with discipline from those who donated their capital. The plumbing under the entire financial system just showed its cracks. And if you don't understand what caused this, you'll be defenseless when it happens again. Welcome to John Analyst. Gentlemen, if you've built something in your career, if you understand that markets don't reward emotion, then you're in the right place. This channel doesn't chase trends. We analyze structure. If that sounds like the kind of work you respect, go ahead and subscribe. Think of it as joining a briefing room instead of a trading floor. And do me a favor, drop a comment below. Tell me where you're watching from today. New York, London, Singapore, Mumbai? I want to know who's paying attention to what actually matters. Let's begin. The flash crash arrived without ceremony. No warning bell, no countdown. Just synchronized destruction across every major asset class within a single hour. Gold fell sharply, silver dropped harder, stock indices slid, cryptocurrency markets bled in perfect rhythm. And the pattern itself revealed something far more important than the losses. This was not human decision-making. When millions of traders make independent choices, markets move in waves. Hesitation appears, pauses develop, rally attempts emerge. But when assets fall together in tight coordination across different exchanges, different time zones, different regulatory frameworks, that's machinery executing pre-programmed instructions. Algorithm-driven force selling doesn't ask questions. It responds to triggers. A volatility threshold gets breached. A risk model flashes red. A liquidity gauge drops below acceptable levels. And within milliseconds, sell orders flood the market from automated systems that don't care whether they're dumping gold bars, tech stocks, or Bitcoin. One machine sells, price moves. Another machine reads that movement as confirmation and sells. A third system hits its stop-loss parameter and liquidates everything. Suddenly, a controlled descent becomes an avalanche, and the market runs on autopilot. This is the infrastructure of modern finance. Not conspiracy, just code. Veteran risk managers watched the charts and saw exactly what was happening. One described it plainly. People hunt for a single headline to blame. They want a villain. But the real cause is feedback loops. Machines talking to machines until human judgment becomes irrelevant. And here's the dangerous part. The story participants tell themselves afterward determines how they position for the next event. Blame the wrong catalyst, and you'll hedge against ghosts while the real threat approaches from a different direction entirely. The immediate aftermath brought predictable reactions. Social media filled with apocalyptic predictions. Some claimed this was once-in-a-decade behavior. Others compared it to the 2008 financial crisis or the pandemic panic of 2020. Chart overlays appeared showing historical parallels, and the conclusion was always the same. Something massive is coming. But pattern recognition without mechanism understanding is fortune-telling, not analysis. Yes, major gold and silver movements often correlate with trust events, banking stress, policy pivots, currency devaluation fears. But the movement itself doesn't predict one specific outcome. Sometimes the move is the event, sometimes it's front-running the event, and sometimes it's simply capital searching for a safer position while the building burns. The challenge for serious participants is separating signal from theatrical noise. Because while crowds debated which headline caused the crash, the actual machinery of markets continued operating according to its design. Liquidity providers widened spreads, margin requirements tightened, clearinghouses adjusted collateral demands, and participants with insufficient buffers found themselves forced into sales they didn't plan, at prices they didn't choose. This is forced liquidation mechanics, not philosophy, not sentiment. Just contractual obligations being enforced by automated systems that measure risk in mathematical terms, not human ones. And beneath all the surface chaos, one question mattered more than any other. Was this a temporary mechanical dislocation or an early warning of structural breakdown? The answer separates two completely different strategic responses. If this represents temporary volatility driven by algorithm overshooting and liquidity gaps, then disciplined participants treat it as a clearance event. Assets went on sale due to plumbing problems, not fundamental deterioration. The appropriate response is systematic accumulation at discounted levels while others panic. But if this signals deeper fractures in market architecture, if the synchronized selling reveals that too many promises have been written against insufficient real assets, then the game changes entirely. Physical delivery demands could overwhelm paper contract systems. Cash settlement clauses might activate. Premiums could explode as participants discover that ownership and price exposure are not the same thing. The business community watching these developments faces a straightforward decision point. Understand the difference between price volatility and structural failure, or operate blind while the landscape shifts. Because what happened in that single hour wasn't an isolated event. It was a stress test. The financial system's plumbing just experienced pressure. Some joints held, others showed cracks, and the participants paying attention learned exactly where the weaknesses hide. The next wave is already forming. The only question is whether you'll recognize it before the machinery activates again. The synchronized collapse revealed the truth. Markets don't move on news anymore. They move on infrastructure. Two markets, same metal, different realities. While traders watched spot prices flash across screens in New York, physical buyers in Shanghai were living in an entirely separate universe. The disconnect wasn't minor, it was structural. And it exposed something the paper market desperately wants to ignore. Physical silver and paper silver are not the same asset. One you can hold, one you can trade. And when stress enters the system, that distinction becomes the difference between ownership and exposure. The rumor arrived late in the trading session, unverified, unsourced, but impossible to ignore. A major government mint would pause silver product sales within 24 hours. No official statement, no confirmation, just whispers moving through dealer networks and online communities. Does it matter if the rumor is true? Not immediately, because markets don't run on truth. They run on belief. And if enough participants believe physical supply is tightening, they act, they buy, they hoard. And suddenly the rumor creates its own reality through behavioral chain reactions. This is how supply shocks begin, not with actual shortages, with fear of shortages. And here's what separates sophisticated participants from reactive ones. Understanding that physical markets operate under completely different constraints than electronic derivatives. When someone buys a silver futures contract, execution happens in milliseconds. Click. Position acquired, no shipping, no verification, no warehouse receipts. Just a number on a screen representing price exposure. But physical acquisition involves friction that cannot be algorithmed away. Dealers must verify inventory. Mints must produce coins. Refineries must cast bars. Transportation must move tonnage across borders. Authentication must confirm purity. And every step introduces time, cost, and potential failure points. That friction is why premiums exist. Premium is the gap between the paper reference price and what participants actually pay for tangible metal. During calm periods, premiums stay modest, perhaps a few percentage points above spot, convenience fee, nothing dramatic. But when volatility spikes and physical demand surges, premiums don't just rise, they explode. Small recognizable coins disappear first. Premiums on American Silver Eagles can jump 10, 15, 20% above spot within hours. Not because silver's intrinsic value changed, because scarcity is being priced into the most liquid, most trusted form factor. Meanwhile, larger institutional bars might show smaller premium increases, less convenient for retail buyers, harder to divide later, but available. And this creates the paradox that traps uninformed participants. They watch spot price crash on their screens and think they're getting a bargain, while real-world acquisition costs are climbing simultaneously. They're optimizing for the wrong number. Now add the international dimension, the Asia-West pricing gap. Reports surfaced of silver trading in major Asian hubs at meaningful premiums to Western spot quotes. Not temporary arbitrage opportunities that close within minutes. Sustained divergences that persist for days, sometimes weeks. Why? Because regional demand, local supply chains, and currency dynamics create separate pricing ecosystems. When Asian buyers face capital controls, import restrictions, or delivery delays, they pay whatever premium is necessary to secure physical metal locally. The paper market in New York can quote $75 per ounce. But if Shanghai buyers are paying $82 for physical delivery, which price is real? Both, and neither. Paper prices reflect derivative contract valuations in high liquidity electronic markets. Physical premiums reflect actual transaction costs in constrained supply environments. And the gap between them measures stress in the system. When that gap widens, it's signaling something critical. Confidence in paper claims is eroding. Which brings us to the phrase that appeared repeatedly during the flash crash analysis, forced cash settlement. Here's what it means in plain language stripped of legal jargon. Some derivative contracts include clauses allowing exchanges to settle in currency rather than physical delivery under emergency conditions. A participant buys a contract expecting to receive metal. Market stress hits. Vault inventory can't meet delivery demands. The exchange declares force majeure or invokes settlement rules. Instead of silver, the buyer receives cash at a price determined by the exchange, based on a reference rate that may not reflect actual physical availability. The promise changed. The contract was rewritten mid-game. Is this legal? Often, yes. The clauses exist in the fine print. Is this fair? That's a different question entirely. And here's the strategic implication. Participants who don't understand the difference between paper exposure and physical ownership are holding instruments they don't fully comprehend. They think they own silver, they own a promise, and promises break under pressure. The second phone call came at dawn. Same friend, different tone. Last night was anxiety. This morning was conviction, bordering on recklessness. Silver had climbed overnight. Charts showed green candles stacking. Social media declared the breakout inevitable. And he was ready to commit his entire allocation in one transaction because, and these were his exact words, "If I don't buy now, I'll miss the whole move." This is how capital gets destroyed, not through bad market analysis, through good analysis executed with terrible discipline. Because here's the reality that separates wealth preservation from wealth donation. The quality of your entry matters more than the direction of your prediction. You can be right about the trend and still lose money if your execution is garbage. The conversation that followed wasn't about whether silver would rise. It was about whether he would survive the journey. First principle, understand what you're actually paying. Most participants see a spot price quote and assume that's their cost. It isn't, not even close. Spot price is a reference number, a benchmark. The number financial media reports because it's clean and simple and fits in a headline. But when physical metal changes, hands in the real world, the transaction includes layers most people never calculate. Premium above spot. The dealer's margin for sourcing, storing, and verifying inventory. During call markets, maybe 3 to 5%. During volatility spikes, 10 to 20% or higher. Shipping costs, especially for international orders or bulk purchases. Insurance, particularly for high-value shipments that require secure transport. Authentication services if you're buying secondary market products. Assay fees if you're dealing with large bars that need purity certification. And the hidden cost nobody discusses, liquidity friction when you eventually sell. Because the premium you pay going in doesn't guarantee you'll recover it coming out. Sell during a market downturn and dealers will quote you spot minus a discount. That premium you paid evaporated. So the first operational discipline, know your true all-in cost. Not the number on the screen, the number that leaves your account and never returns. Second principle, never deploy your full position on the first entry. This single rule prevents more catastrophic outcomes than any amount of market analysis. If you commit everything immediately and price rises, yes, you maximize gains. Congratulations, you also just taught yourself the worst possible lesson. That reckless execution works. And that lesson will eventually destroy you when the pattern reverses. But if you commit everything immediately and price collapses, you're paralyzed. No ammunition left, psychologically damaged, watching better prices appear while you're fully allocated at worse levels. The mathematics are simple. Cut your intended purchase into thirds. Execute the first third. Wait. If price rises, you're participating. Not optimally, but participating. If price falls, you have capital available to average down at genuinely better levels. This isn't cowardice. It's operational intelligence. Third principle, define your purpose before the transaction, not after. Are you acquiring physical metal as long-term store of value? Then prepare mentally to hold through volatility that will test your conviction. $70 silver becomes $60 silver, then $55, then bounces to $80. If your plan requires selling during those swings, you're not building a position, you're trading. And trading physical metal with premium spreads and delivery delays is like running a marathon in wooden shoes. Or are you speculating on price movement? Then don't pretend it's a forever hold when the chart turns against you. Set stop-loss parameters, accept losses, move on. The disaster happens when participants blend these approaches unconsciously. They buy with trading timeframes, but hold through drawdowns telling themselves it's long-term strategy. Then they panic sell at bottoms because the loss became psychologically unbearable. Clarity of purpose isn't philosophical, it's operational necessity. Fourth principle, stabilization beats bottom fishing. When flash crashes hit, the instinct is to catch the falling knife, find the exact low, maximize the entry advantage. This is ego talking, and ego doesn't profit. Instead, watch for stabilization signals. The speed of decline slows, price starts chopping rather than free-falling. Bounces stop making immediate lower lows. It's messy, it never feels safe. But it's the difference between buying into continued collapse versus buying into potential recovery. The friend deployed 1/3 of his intended allocation near stabilization levels. Not the bottom, not the top of the bounce, somewhere in the middle of the chop. Then we waited, watching. Ready to execute the second third only if price deteriorated further. The perfect price is worthless if fear prevents execution. The executed plan beats the perfect theory, every single time. The flash crash is already history. What matters now is what it revealed and what's forming next. Because volatility events don't arrive randomly. They arrive when structural pressures accumulate beyond system capacity to absorb them quietly. And the participants who understand this don't waste energy predicting exact timing. They watch for the indicators that precede the next wave. 3 signals matter more than everything else combined. First signal, premium curve distortion across product types. Physical silver products don't all behave identically during stress. Small recognized coins, generic rounds, large institutional bars, and specialty collectibles each serve different buyer segments with different urgency levels. When markets are calm, premium relationships stay relatively stable. American Eagles might carry 4% over spot, generic rounds 3%, 100-ounce bars 2%. But watch what happens when supply chain stress builds. The most liquid, most recognizable products disappear first. Eagles vanish from dealer inventory. Their premiums spike to 12, 15, 18% above spot. Meanwhile, larger bars that require more capital and offer less flexibility might only see premiums rise to 5 or 6%. This spread widening is the tell. It signals that retail physical demand is overwhelming available supply in the most accessible formats. Buyers are paying anything necessary to secure recognizable metal, while institutional products remain comparatively available. When premium curves distort dramatically, it's not noise. It's the market screaming that paper pricing and physical availability have divorced. And historically, that divorce doesn't end peacefully. Second signal, inventory deterioration at major dealer networks. Physical metal doesn't teleport from refineries to buyers. It moves through distribution infrastructure, authorized dealers, wholesale networks, mints, and vault facilities. Smart participants don't just watch prices, they watch inventory availability. When a major dealer's website shows in stock across all product lines, supply chains are functioning normally. Delays might be a few days, premiums stay reasonable. But when inventory statuses start shifting to limited availability, then backorder, then temporarily unavailable, something is breaking in the supply pipeline. Production can't keep pace with demand. Refineries are running full capacity but still falling behind. Mints are rationing allocations to dealers. Shipping timelines extend from days to weeks. This happened during the pandemic panic. It happened during the 2011 silver surge. And the pattern always follows the same sequence. First, small delays appear, then premiums rise, then product availability collapses entirely for certain formats. And by the time mainstream media reports the shortage, informed participants have already positioned. Monitor dealer inventory status weekly. When 3 or more major dealers simultaneously show widespread back orders across multiple product types, the next supply crisis is already underway. Third signal, regional price differential expansion. The Asia-West pricing gap discussed earlier isn't just an interesting market quirk. It's a structural stress gauge. Under normal conditions, arbitrage keeps regional prices relatively aligned. If Shanghai silver trades significantly above New York spot, intermediaries buy Western metal and ship east until the spread narrows. But when that spread persists, when Asian buyers consistently pay 5, 8, 10% premiums above Western spot for weeks, it means arbitrage mechanisms are failing. Either capital controls prevent money from flowing freely, or shipping constraints prevent metal from moving efficiently, or import restrictions create artificial scarcity in high-demand regions. Whatever the cause, sustained regional divergence signals that global physical markets are fragmenting. And fragmentation precedes crisis. Now combine these 3 indicators with one more critical understanding. The gold-to-silver ratio. This ratio measures how many silver ounces equal 1 gold ounce in value. Historically volatile, it tells you which metal is crowded and which is being abandoned. During the pandemic panic, the ratio spiked to 125. The market was screaming, trust gold, dump everything else. During the 2011 silver mania, it compressed to the low 30s. Silver was the speculative darling. Currently, the ratio hovers in the high 40s to low 50s. Not extreme fear, not speculative euphoria, somewhere in between. But watch for movement. If the ratio starts compressing rapidly toward 40, silver speculation is heating up. If it expands toward 70 or 80, fear is driving flows back toward gold. Neither is inherently bullish or bearish. Both tell you about positioning, liquidity preference, and which side of the trade is getting crowded. Here's the final operational framework. Markets don't reward prediction, they reward preparation. Write down your maximum position size before volatility hits. Document your entry schedule. Define your cost basis parameters. Identify your verification process for counterparty reliability. Then execute mechanically when conditions align, because the next flash crash won't announce itself with sirens. It'll just happen. And the participants with written protocols will treat it as opportunity, while everyone else experiences it as catastrophe. Strategic positioning beats market timing. Discipline outlasts volatility. The structure is showing cracks. The question is whether you'll be ready when it breaks.